Alright, oil and gas lending industry overview. Oil and gas, or ONG, lending is complex and highly specialized due to factors such as global supply, demand, geopolitical uncertainty, weather-related disruption, fluctuation, volatility in current markets, the strength of the U.S. dollar compared to the global current markets, and change in environmental or other governmental policies. As such, companies and borrowers directly and indirectly tied to the oil and gas industry frequently experience expansion and contraction within the key operational areas of the business that will directly impact the financial condition and repayment capacity. Oil and gas industry has four interconnected segments: upstream, exploration, production, and companies. Midstream, transport and treating, processing, storing, marketing, upstream companies. Downstream, refining and marketing. And support services, equipment services, support activity, drilling, workover units, water hauling, instruction, and services. Oil and gas lending to the upstream companies of the exploration and production activities specialized from a form of lending. In a primary focus section, see reserve-based lending below. Loans to midstream, downstream support service companies are generally structured similar to the other commercial loans. In addition, midstream companies often raise capital through the master limited partnership that are publicly traded, but the highest credit risk is typically found in support services upstream lending, which are more directly affected by changes in production commodity prices. Reserve-based lending. Loans in the exploration and production activities are typically secured by provided with a reservoir governed by borrowing base, an arrangement known as reserve-based lending, or RBL. Effective credit or risk management in reserve-based lending requires conservative underwriting, appropriate structuring, experienced knowledge, lending staff, sound loan administration practices. It's also important that the board of senior management consider the unique risk associated with the type of lending when developing reserve-based lending policies, approving and administrating such loans. These risks include, but are not limited to, credit concentration, market volatility, price, limited purpose, collateral, production, operation, legal compliance, environmental, interest rate, liquidity, strategic, and third-party risk. Reserve-based lending may appear similar to traditional assets-based lending, or ABL, but there is a notable difference. The primary source of the repayment of asset-based lending is orderly liquidation of the collateral, receivables, inventory, into cash. Such loans are typically structured with strong controls over the collateral, such as the lockbox arrangement. In the contrast, primary source of the repayment of reserve-based lending is the cash flow derived with extraction of oil, gas reserves. An independent third party to reserve engineering report serves as a primary underwriting tool to estimate the future cash stream. Establish a borrowing base, which is collateral-based agreed with the borrower or lender, used to limit the amount of the funds the lender advises borrower. Borrowing base is subject to periodic redetermination, typically semi-annual, that can result in reduction in borrowing base commitment when commodity prices reserves are declined. Alright, type of reserves. Lenders should generally only consider provided reserves defined having at least 90% probability and the quantities actually recovered with equally exceeded the estimate of determining collateral value. With proved reserves category, proved developed producing, improved developed non-producing, and proved undeveloped reserves are collectively known as P1. As described in proved developed non-producing and proved underdeveloped reserves require capital expenditures, or CAPEX, to bring non-producing undeveloped reserves online to proved developed and producing. Proved developed producing represents a reserve of the recoverable for existing wells, existing equipment, operating method that are producing at the time of the engineering report estimate. Proved developed non-producing reserves include both the shut-in of the PDSI or behind the pipe reserves. Production can initiate and restore with a relatively low expenditures compared to the cost of drilling in a new well. PDSI reserves are completion intervals that are open. They're not started producing, shut in, market conditions, pipeline connections not capable of production for mechanical reasons, and pre-developed bake behind the pipe reserves are expected to recover for the existing well require additional completion work for future completion prior to starting the production. Proved undeveloped reserves are expected to be recovered only after making future investment. Reserves have been provided independent engineering reports but do not have well infrastructure in place. Other category reserves include probable P2 and possible P3. Probable reserve are the relatively uncertain, when the possible reserves are considered speculative to the nature. Probable and possible reserves should not receive any value when determining the borrowing basis. Reserve engineering reports. Reserve engineering reports are estimates of the volumes of the oil and gas reserves. They are likely to be recovered based on the reasonable assumptions regarding physical characteristics of the reserve, available technology, operating efficiency, significant reliance on the engineering reports, underwriting, reserve-based lending. Facilities require sound internal controls, collateral evaluation process. Reserve reports must be objective, based on reasonable, well-documented assumptions completed independently of the loan origination, collection functions. It is important for the management due document of the qualifications and independence of the engineer to periodically evaluate the production performance, which includes a comparison of the production projects and actual results. Reserve-based lending collateral value consists of the point-in-time estimate of present value, future net revenue derived from production, sale, existing oil, gas reserves, net of the operating expense, production, taxes, royalties, capital expenditures, discounted with appropriate rate. With the engineer report shall contain sufficient information, documentation, support, assumption, analysis, used to derive forecasted cash flows, and discounted present value. Well-managed banks provide clear guidance to the engineer and engagement regarding discount rates, pricing assumption, operating expense escalation rates, and risk adjustment guidelines limiting high-risk reserves. The engineer will conduct analysis of production reports from the subject properties and projected estimated reserve depletion. Alright, borrowing base, collateral base search. Each of the facilities should not be primarily compromised with the PDP. Include proposed PDMP. Reserve collateral evaluation should be supported sufficient documentation to demonstrate that the borrower with the financial capacity for proposed developed non-producing reservoirs and develop reserves by making necessary investment restore initial production with a near term. To include possible underdeveloped and borrowing base calculation, borrowers should have sufficient liquidity, positive free cash flow to meet operational needs, debt services requirements, as well as to be able to fund with obtaining the funding for the capital expenditures that would be required to convert the undeveloped reserve into production. Potential sale with and or marketability of possible undeveloped reserves can be considered when evaluating collateral values, provided there is adequate documentation recent of the possible undeveloped sales. Lenders of risk adjustment factors lower the value of the unseasoned non-producing reserves before applying them to the borrow base advance rates. And important to consider policy limit the production, non-production reserves. The oil and gas mix makes production coming from one well, single well, concentration risk, other risk adjustment factors, and daily management achieve the diversification and geographical location reserve fields, and establishing limits the lowest number of the production wells needed to establish acceptable borrowing base. Typically, the advance rate of the high quality provided with the P1 reserves rarely exceeds 65% of the typical range, 50 to 65% of the present value of the FNR, and lender determining the possible developed non-production and possible undeveloped reserves are to be considered, and the borrowing base of the reserve should generally not exceed 25 to 35% of the total borrowing base. In addition, with the PDMP, And PUD reserves should be risk associated adjusted 65-70% with a PD for PDMP and 20-50% where possible undeveloped. For example, prior to applying an advance rate, the lenders may apply separate risk adjusted advance rates for each provided reserve category borrowing base. During extended periods of low decline, commodity prices is not uncommon for the banks to increase the risk adjustment of the PDMP and PUD reserves. As part of the underwriting profit, the lending personnel typically are both the base case and the sensitivity cases analysis. The focus on the ability of converting underlying collateral into cash, repaid loans, including estimates, impacts, sustained adverse changes in the market conditions would have the company's repayment ability by a base case analysis. Use standards assumption scenarios generally include the discount to current prices against forward curve, projected futures price, estimating the commodity. Sensitive case analyze subject oil, gas reserves, adversely external factors such as low market price, higher operating expenses to the assertion of the effect of the loan repayment. Full debt services capacity is typically analyzed by both baseline case and sensitivity case scenarios. Discount rates. The Security Exchange Commission requires that public trade companies to report the value of their reserves using standard discount rate of 10% in accordance with the ASC Topic 932 extractive of the activities of oil and gas and evaluating collateral valuations for reserve-based lending facilities. Banks often utilize alternative discount rates for credit-worthy borrowers during no more than beginning operating cycle. 9% discount rate is commonly used for the high-risk borrowers during volatile decline in market cycles. For oil and gas, higher discount rates are typically used if the discount rate is selected with a significant difference from the generally accepted discount rate. Examiners should assess the management documentation supporting and rational. Some banks have multiple discount rates under certain circumstances. Example may include establishing a standard discount rate for performing credits and a higher rate for higher risk facilities. Alright, price deck. Prudent management regularly evaluates, updates with the necessary its pricing assumption of the reserve-based lending, commonly referred to the institution price deck. Price deck is a forecasted use derived cash flow collateral value assumption type approved by the board of the directors, specifically designated board committee. Pricing assumption typically represents the most significant variable in driving the financial estimate value of the must be well suited. Each extent of the price deck typically refers to both base case with the sensitivity case pricing scenarios. Pricing assumption for a sensitive case are generally sufficiently conservative than you to determine whether the borrower has the financial capacity to generate adequate cash flow to pay the debt during a prolonged low commodity price environment. Price deck consideration include, for example, the current commodity pricing, forward curve projection, future price consideration, cost assumption, discount rates, timing of the various reports, management, typical documents, any risk-based adjustments apply with each of the provided reserve category. While the risk-adjusted base case projections will generally be used to underwrite reserve-based lending, consideration is given to the ability to repay with the debt using risk-adjusted sensitivity case, determining potential exposure due to the adverse market price fluctuation. Loan structure. Reserve-based lending credit facilities are typically structured with a revolving line of credit. Reducing a revolving line of credit or amortizing term loan governed by a well-supported, fully documented borrowing base. These credit facilities generally fully amortize within half-life of the reserves. This is the time in the years required to produce one half of the total estimated recoverable production, with repayment alignment with the projected cash flows. In other words, the term of the loan should be applied to economic life of the underlying assets. So this is often representative of the reserve tail tests that are based on economic half-life of the reserves of the cash flow remaining after projected loan payout. Loan duration shall be fairly short-term, directly tied with the economic life of the asset. If it's given that generally 50-60% of the economic life removed the reserves to provide with the reserve half-life of the terms generally depending on the projected actual reserve production, reserve run data, as well as the type of the range of the PDP, PDMP, and PUD. Reasonable portion of estimated revenue should remain after the debt has been fully amortized. Reserve tail borrowing base should be redetermined at least semi-annual subject updated reserve engineering report. Alright, covenants. Appropriate use of covenants is imperative of managing credit risk of the oil and gas loans. Lenders typically require financial covenants and instill discipline in lending relationships, including borrower's leverage position, repayment capacity, liquidity. In addition, design covenants, limited cash distribution, owner shareholders include standard performance financial reporting requirements. Example: covenant ratio covenant for explaining with the exploration production companies include free cash flow, interest coverage, fixed charge coverage, current ratio, quick ratio, senior debit or EBITDA, or total debit EBITDA. The calculation earning before the interest, tax, depreciation, amortization. Typically, interest incorporates capital expenditures due to the impact of the amount projected when the free cash flow is available after the debt serves to support the operation. Alright, hedging. When used properly, hedging may be an effective tool to help protect the borrower or lender from sharp commodity price declines, providing a stable, flat cash flow. Exploration production companies frequently use hedging instruments such as future contracts, swaps, collars, put options with a reduced price risk exposure. Generally, hedges should be limited to no more than 85% of the projected production volumes. Counter prices typically limited to the reputable financial sum of the company for the proof of the according for the institutional oil gas loaning policy. If the hedges are taken as collateral part of the borrowing base, advance rates and limitation of the hedging position should be documented in a loan agreement. If the hedges are sold, monetized, and the proceeds as such is generally applied to the respective debt. Alright, borrower financial analysis. Management should have clear understanding of overall financial health of the borrower, include the assessment of the borrower's ability to maintain operations through adverse market conditions. Exploration production companies, sound financial conditions should have strong cash flow with a reliable revenue sources, well controlled operating expense. Companies should also have an adequate source of liquidity, effective working capital management, sound reserve development practice, well-defined criteria with the diversity, adequate capital structure, managed level of the debt, appropriate financial reporting as part of the overall financial analysis of the relationship, updated with the engineering data, should be well documented and should be enable the lender to determine the borrower's capacity for the serve of the debit. Any over advanced situation should have a reasonable plan time frame to cure over advance. Principles of successful exploration production companies should be experienced with have a well-documented track record of managing through all stages of the business cycle. In good times, company management should be able to identify, acquire, develop, reserve profitability in line with the expectations during decline price cycles. Company management should be able to demonstrate the ability of the streamline operation, maintaining reasonable production, managing work capital strategically with the capital expenditures, make sound with diversity, ensure repayment of the debt. Bank management should evaluate the borrower's cost cycle to reflect not only the ability to generate cash flow production, but also capital expenditures necessary to replace depleted reserves. Working capital management, critical important deduct delinquent payments to vendors on the result of the negative working capital position due to accounts payable, increased leverage ratio. Financial action analysts typically include the following: adequacy of the operating cash flow, service existing total debt, overall compliance, financial covenants, including borrowing base limitation, detail of the loan agreement, reasonable life over the company's budget assumption of the projection, comparison of the borrower provided with the production projections of the actual results, working capital, tangible net worth, leverage positions, and impact of the capital expense of recent acquisitions. Oil and gas loan policy guidelines. Oil and loan gas policy should provide sufficient guidance to the loan officer, clearly convey appropriate policy limitations, monitoring procedure details, appropriate underwriting standards, practice for the oil and gas policy should clearly indicate the industry segment, upstream, midstream, downstream support, service of the board choice. The board chooses to lend to and include guidance on each of these segments. For institution engage in reserve-based lending, appropriate policies, diversely reserve measurement, valuation analysis, borrowing base determination, production history analysis, final statement of the ratio analysis, commitment, advances, discount rates, price deck formulation, financial covenants, steps secure over advanced situations, and all considerations. Specific guidance typically cover the following areas. Alright, lending objective, the risk appetite portfolio, limit the target markets, concentration, limit the methodology, and requirements monitoring oil and gas markets, including price, supply, demand trends, overall market trends, industrial analysis, board and committee oversights over oil and gas lending, engineering departments. Officer committee, lending limits, borrowing base calculation, risk adjustment, price deck, consideration adjustment, advance rates, risks associated with a PDP, PDMP, and possible undeveloped reserves, requirement of risk adjustment of the discount value of the non-producing reserve before applying advance rates, frequency required details of borrowing base redetermination, price deck of evaluation requirements of the independent engineering reports analysis thereof, well concentration guidelines, maximum per single well, limited financial covenants, minimum ratio, other financial information requirements, review of the requirements of current ratio, fixed charge coverage, cash flow coverage, leverage ratios, collateral valuation requirements, including required remain collateral as payment and payout, renewable restructuring guidelines, including non-accruable debt restructuring implications, remedy decline cultural over advanced situations such as monthly commitment reductions, pledge of additional reserve of the collateral sale of the non-productive reserves, minimum required insurance, including property liability, environmental defined loan source safety coverage factors, loan value policies, including other debt ways, all debt sharing equal with the production cash flows available to amortize debt. Typical amortization, payout, loan repayment terms, including maximum term for production, revolvers, term loans, guarantee requirements, hedge requirements, policy limitations, stress testing, sensitivity analysis, requirements thereof, and monitoring requirements of risk, inherent loan dependent on royalty, interest, production, revenues for repayment. Alright, credit risk assessment and classification guidelines is an appropriate oil and gas loan policy. Also addresses specifically credit policy risk review process for the oil and gas portfolio, oil and gas loaning grade rating criteria. Risk rating definitions should be clearly identified with the reserve-based lending, adequate protected by the current sound-worthy debt service capacity of the borrower and guarantor underlying collateral generally will not adversely have classified for supervisory purposes. However, if any of the following circumstances are present, more in-depth, comprehensive analysis of the credit is needed to determine whether the loan is potential weak or well-defined weaknesses. The loan balance should exceed 65% of the personal present value of the FND or of the FNR and of the PDP proved developed reserves. The cash flow analysts indicate that the loan will not amortize with the reserve half-life. Credit is not performing in accordance with the contractual terms, repayment, interest, and principal. Advance rates exceeding institutional limitation, industry standards for approved reserve. The frequent over-advance will occur with subsequent borrowing-based redemptions. Redetermination, excessive operational leverage, covenant default, delinquent payables, other evidence of poor working capital management, significant current like future disruptions in production, frequent financial statement revisions, change of the chosen accounting method, maintenance and capital expenditures significantly exceeding budget forecast, credit identified by institution as a distressed credit. Our examiners are considered all information relevant to the evaluation of the project prospects for the loan will be repaid, including with the borrower's credit worthiness, each of the cash flow provided with the borrower's operation collateral, supporting loan, integrity, reliability of the engineering data, borrowing base, consideration, primary scope of the repayment, any support provided with the financial responsible guarantor, co-borrowers, reveal well-defined weakness, adverse classification, loan relationship. It's likely warranted to level the severity of the classification distress of the collateral dependent on the reserve-based lending. Will depend on the quality of the underlying collateral based on the most recent redetermined risk-adjusted borrowing basis contractual obligated to be funded. The portion of the loan commitment secured with the non-present value Net present value as the total risk adjusted approved reserve should be classified as a standard with the potential for loss with the mitigated with the outcome when the certain depending events when loss is expected with the balance of the loss cannot be reasonably determined. Remaining balance secured by the net percent value of the total unrisked approved reserves should be classified doubtful if the portion of loan commitment exceeds 100% of the net present value of the total unrisked approved reserve. The uncollectible should be classified loss. Guidelines may be adjusted depending on the borrower's specified situation, should not replace examiner's judgment. The following tables illustrate an example of the rating methodology classified borrowers, actual pricing, discount rates, risk adjusted. The factors applied with the institution may vary. According to current market conditions, nature of the reserve, the examiner should closely review the assumption made by an institution in arriving at the collateral valuation. Example: collateral valuation in millions, discount with a net value, net percent value of 9%, even net max strip pricing valuation price, basis hedges, and then your petroleum unrisked and borrowing base commitment. Note that $25 million doubtful the difference between the unrisked and that net percent value, risk net percent value, if the borrower's perspective will further develop the PDMP and PD reserves, producing status unlikely not supported with the pending event of the amount should be reflective loss. An institution should follow with accounting principles when determining whether the loan should be placed with a non-accrual. Each extension should be independently evaluated to determine whether there would be non-accrual. That is, non-accrual status should not be automatically applied to multiple loans extension with a credit single borrower. Only one loan meets the criteria for the non-accrual status. However, the multiple loans to one borrower are structured pari passu to principal interest if it's supported by the same repayment source. Should not be treated differently for the non-accrual trouble debt restructuring purposes with regards for the collateral lien position. Alright, that takes care of oil and gas loaning, and it goes into real estate. So, I picked the wrong way to go. Alright, this is oil and gas lending industry overview.